All right, welcome back to part four. I think part four. But just in entries um, for step five of the accounting cycle, which is analyzing, journalizing, and posting adjusting entries. And last time we were covering deferrals, prepaid expenses, and unearned revenues, the two types of the deferrals under accrual accounting. Again, deferrals are postponements. As far as expenses, you are postponing the use or consumption of those expenses, and for revenues, you are postponing the provision of a service or the sale of merchandise, or sorry, the delivery of merchandise, even though cash is received in advance. For prepaid expenses, cash is paid in advance. Okay, that's another thing about these journal entries and stuff like that. You got to think in terms of the buyer or the seller. Whether you are the buyer or the seller. So always put the hats on of the different um, people, right? Different entities, buyer or seller. So here we have an example that's going to look at deferrals. Okay, so this would be part four in totality for adjusting entries under step five, and then probably the last part for deferrals. Okay, but they come up throughout your accounting textbooks. Okay, you gotta like Denzel said in that one movie, you gotta dive into accounting. You gotta smell that shit, right? You gotta get into these books and just make accounting your whole world, whole wide world. Okay, so here we have an example for deferrals. Okay, the Ledger of Hammond Inc. on March 31st, 2017. So that's when their period ends. They're just using monthly artificial time periods just to make it simple. Includes these selected accounts before adjusted entries are prepared. So here we have sort of a trial balance, okay, because that's where you prepare the trial balance from the ledger, okay. So this is not a ledger. Um, this is a trial balance. This is where they got these numbers from, okay. Prepaid insurance, supplies, equipment, and then we have accumulated depreciation, unearned service revenues. Notice they are listed in terms of how they appear on the balance sheet. Assets appear first on the left hand side, read it from left to right. Then we have liabilities, and then we have all the stockholders' equity accounts, which includes revenues and all that good jazz, right? Debit and credit columns, so these are classified appropriately. Remember, accumulated depreciation it goes under assets, but it's a contra asset. That's why it is appearing on the credit side here, okay? And then it tells us all this information. Analysis of the account shows the following. Insurance expires at a rate of $100 per month. $100 per month. So that's our prepaid insurance. $100 per month. So this must be a 3-year insurance policy, right? 3-year insurance policy. Because 12 divided by, or 3,600 divided by 12 is 3. Yes, and then that would make it what, $1,200 a year. 1,200 divided by 12 months is 100 per month, if my math is correct. Again, accountant does not need you to be a math genius. I should have pulled out a calculator, but you know, I like to use my brain sometimes, right? Don't we all? Okay. So that's insurance, okay, at a rate of $100 per month, and this is monthly, so we're good to go. Supplies on hand total 800. So the first one, they gave us a number, okay, expires at 100 per month. So for a journal entry, we know that the figure that we're going to use is 100 per month. We don't have to do any calculations there. Here, supplies on hand total 800. Well, supplies on hand total 800. What does that mean? When it says on hand, that means what you have in that supply closet as a company, okay? What you have left, okay? It's like food on hand. Let's say you go to your cupboard and you have 4 slices of bread. Then what you have on hand is 4 slices of bread. Okay, that's what you have left over. That is not what you used. Okay, maybe you started out with 12 slices of bread. If you have 4 on hand, then you used 8 slices of bread. In this case, we started out with 2,800. 2,800. Okay, so when it says supplies on hand is 800, what you have to do is calculate the difference. So you take 2,800 less that 800, and that is 2,000. That is what you used. Okay, if that makes sense. 2,000 is what you used. Then we have equipment depreciates 200 a month. 200 a month. That is the depreciation. Um, Here, they give us the number again, 200 per month. You can do the calculation on that all you want. So far, they have the cumulative depreciation at 5,000, so they're already depreciated 5,000 already. Okay, 200 per month. Um, 200 per month. What is that? 25,000. 200 per month is, what is it? 2,400? Is it 2,400? Not sure. So this might be 2,400. This equipment, as you will see later, this might have a salvage value of 1, and it might have useful life of 10 years, and it might be under straight line depreciation, so $2,400 a year, if my math is correct. If my math is correct, but maybe it's not. So, but anyways, they give us the number, so that's fine and dandy. So we're gonna use that 200. That's going to be the number that we're going to use for adjusting entry. During March, services were performed for 1/2 of the unearned service revenue. Okay, so here we do have to do a little calculation. Just divide by 2 because it says 1/2 of the unearned service revenue were performed, and here they tell us that it's 9,200. 9,200. 9,200. Okay, so half of that is earned. Okay, again, unearned service revenue is a liability. Okay, so then it says prepare the adjusting entries for the months of March, and we're gonna do that. For insurance expires at a rate of $100 per month, here's the adjusting entry, just like you've seen in the previous videos. Insurance expense is debited. To transfer that $100 worth of this asset to an expense, which is what it really should be. And then prepaid insurance is credited to decrease the asset, again, to bring the assets to their true balance. Instead of having them be overstated. And then 100, 100. So that's simple enough. If you have any questions about this, ask in the comments, or I don't know. Yeah, ask in the comments, and I'll try to get to you. You know, I'll take my time probably. Anyways, so that's that. And then here, supplies on hand total 800. That's the second things that we have to deal with. Here, we should know the journal entry at this point because we covered it in a previous video. Supplies expense is debited, and supplies is credited. What people get confused on is the number that you should use. Should you use 2,800, 800? No. When it says on hand, that's what you have left. Okay? So at the beginning you had 2,800. At the end you add 800. The difference is 2,000, and that's what you used up during the months. Okay, so that should be your number listed here. 2,000, 2,000, and that's it. 3, the equipment depreciates $200 a month. So they tell us what it is. Okay, we don't have to do any calculation. The calculations are simple once you know more about depreciation methods and how they work. Okay, but here we have depreciation expense debited, accumulated depreciation dash equipment credited, 200, 200. Again, depreciation is an allocation of the cost of this asset as an expense to its useful life. Okay, over its useful life. Okay, over its useful life. Okay, great. So that's depreciation. If you have any questions on depreciation, again, ask, study. Yeah. Then finally, on the fourth thing that they require from us is an adjusted entry for unearned service revenue. During March, services were performed for 1/2 of the unearned service revenue. So originally, people gave us $9,200 buckaroos in cash for a service that we have not yet provided. Okay, they paid us in advance, folks, so we can walk away with that money, or we can be decent pieces of shit and we can fulfill the service, right? So in this case, we are going to fulfill the service, and in this case, we fulfilled one half of this service. So it would not be fair, okay, to list a liability for the whole $9,200 because we don't owe the full $9,200 any longer. We only owe these people half of that, which is 4,600. Okay, simple math. You just have to take 9,200 divided by 2, and that is your number, 4,600. Okay, uh, and then your journal entry is going to transfer from an unearned service revenue, a liability. You're going to debit that to a service revenue account, which is a credit account. Okay, or sorry, a revenue account. Okay, that's what it should be originally. This is what happens because you provided the the service now. You provided the service now, and you have to recognize that revenue so you can paint a holistic picture to these people looking at your financial statements. Okay. I've earned this money now, so I have to recognize it as a revenue. So that's it for deferrals. Hopefully this example helped you or will help you with the understanding of deferrals. Again, if you have any questions, ask, because I am not a mind reader. And by the way, pay me, but I also get paid by the questions. So go ahead and ask away and try to stump me. I don't think you'll be successful. I'll bet my life on it. But try to, okay? Anyways, I'll see you in the next video. We'll be tackling accruals this time and finishing step 5 of the accounting cycle. And then after that, we'll move on to step 6, 7, 8, 9, start over again. All right, see ya.